Good to see you, Yuka. Let's start because Donald Trump's decision to hold off striking Iran for now has had a big reaction.
Yeah, oil plunged and stocks surged after the US president said that he had constructive talks with Iran to resolve the conflict, even though Tehran denied negotiating a deal. The US's WTI crude fell below $90 a barrel, and the international benchmark Brent futures fell 11% to settle just below $100 a barrel. The spread between WTI and Brent has narrowed after a sharp increase over the past 2 weeks. European natural gas prices also eased immediately after Mr. Trump's comment on social media, ending the day down more than 5%. Global stocks jumped at the news, with the Dow Jones Industrial Average gaining as much as 1,000 points earlier in the day. All three main indexes on Wall Street ended the day up more than 1%, as you can see there. European bourses earlier in the day changed direction halfway through the trading day, with Paris and Frankfurt ending with gains. London, though, finished slightly weaker. Now, despite a small respite, oil prices are still significantly higher than before the war began and are expected to stay elevated. Here in France, the Energy Ministry has started looking into the possibility of increasing the capacity of the country's 5 oil refineries, as motorists are already paying higher prices at the pump. The government, though, has not said anything about whether it would lower fuel taxes like Italy and Spain, as it struggles to balance the budget. Luc Schrager and our colleagues at France Télévisions report.
Taxes make up about half of the cost of fuel in France, and as prices climb worldwide, is it now time to bring that duty down?
I'd be behind a tax cut. It seems a good idea, at least, to make a temporary effort.
I think they need to come down anyway. That would suit everyone and mean a few more savings for people.
If we don't have the means, then don't do it. That's the real question.
The government would have to act to cut both VAT and a domestic consumption tax on energy products, something it's so far seemed unwilling to do. French public debt's already over 117% of its GDP, and a tax cut would blow another €17 billion hole in finances.
Cutting taxes, given the current situation, is going to cost public finances dearly. It'll hit growth and it'll hit tax revenues. So again, cutting taxes might cut fuel prices, but at the end of the day, it's still going to seriously cost both the taxpayer and the state.
Other European countries have already made the move, like Spain, Germany, Portugal, Italy and Greece. And on Monday morning, Sweden followed suit, proposing a fuel tax cut that would come into force from May the 1st. However, there are still limits. Brussels won't allow VAT to fall below 15%. In France, it's held at 20%.
Meanwhile, Cuba suffered a second nationwide blackout in a week at the weekend amid a severe fuel shortage caused by an ongoing US blockade. Power was slowly restored after the national electricity grid collapsed, plunging more than 10 million people in the dark. Many Cubans are eagerly awaiting a flotilla carrying humanitarian aid from Mexico, as well as a Russian tanker carrying 730,000 barrels of crude oil. The Anatoly Kolodkin is crossing the Atlantic in the direction of Cuba currently. If the country is indeed the ship's destination, it may not reach it, as the US Navy is policing the Caribbean to choke off Havana's oil supply. Last week, the US temporarily lifted sanctions on the purchase of Russian oil already at sea, but barred Cuba from receiving any. Let's hear what some Havana residents have to say.
We're holding out. We'll see for how long. A Russian ship was on its way. We know it's coming, but it still hasn't arrived. And once again, we're facing a really tough situation.
Many children and families are suffering due to electricity shortages. Without it, hemodialysis can't be done, and children with cancer are suffering because they don't have medicine.
Finally, for business, corporate executives from Apple, Samsung, Volkswagen and others gathered in Beijing for the China Development Forum. The 2-day event on the eve of the Boao Forum in Hainan is the first high-profile international event since the Communist government unveiled its next 5-year plan as it looks to draw more foreign investment amid trade tensions with the United States. Caroline Baum has more.
The world's largest exporter is trying to woo foreign investors. On Sunday, Chinese Premier Li Cheng welcomed business leaders from around the world to the China Development Conference. offering them promises of increased transparency and equal footing with Chinese companies.
Many of those CEOs are in sectors such as pharmaceuticals, healthcare, high tech, and these sectors are areas where they need the China market, so it's a potential win-win.
Beijing is looking to turn around a slump in foreign direct investment, which saw a 5.7% year-on-year drop in January. It's also looking to balance trade. In 2025, China saw a historic $1.2 trillion trade surplus. Now, officials say they're committed to importing more foreign goods. In December, the Chinese government made 200 more sectors eligible for foreign investment incentives, focusing on advanced manufacturing, green, and high-tech sectors. And in its latest 5-year plan, Beijing announced it would invest heavily in biomedicine. Pharmaceutical companies are paying attention.
We recently announced a $3 billion investment in a partnered manufacturing facility here. We've launched many products and now expect to launch all of our products within weeks of U.S. approval.
But the shadow of trade tensions lingers over these promises of investment. Businesses who work in China are still reeling from heavy tariffs imposed by U.S. President Donald Trump in 2025. The president's sweeping trade war has reached a fragile détente, but the future remains uncertain for foreign investors. Last week, Trump delayed a planned visit to China, missing a chance to reconcile the world's two largest economies.
That's it from the business desk.